Dear investor, in this month we shall focus on global market turmoil and volatility in the Indian stock market over the past period, Forex reserves and narrowing trade deficit data, valuations and outlook for financial 24 and the themes that we are focused on. We continue to believe it is time for alpha. The month of March was volatile. Global markets had to digest stress in several banks. Silicon Valley Bank suffered mark-to-market losses and its equity was quickly marked down to zero. And similarly, some other banks, US banks, suffered volatility on the same count. With government paper impacting net worth on account of mark-to-market losses. We have examined this in the Indian context and think that the issue should not crop up in India. If we look at our 10-year bond yields, it was only for a period of around 1 year that the yields were below the current yields. In the US, in comparison, the current yields are the highest that we have seen over last 10 years, implying mark-to-market losses on bulk of government securities held by banks in that country. Moreover, more recently, when US was pumping in liquidity, the yields were negative. That also implies very high MTM losses. What started as a US banking crisis, banking issue, has also caused stress in Europe, and CSFB had to be provided a lifeline and is in the process of being acquired by UBS. The sell-off in banking as a consequence of the above was seen in the Indian market also. Given that our banks are not impacted by what is happening abroad and are reporting continued improvement in the asset book, a sell-off here should prove to be a good entry point for local investors. The issue plaguing global banking is of sharp MTM losses, and lower bond yields would help. That is the solution statement. We have seen a sharp drop in global yields after the SVB issue. Hopefully the lower yields sustain. In spite of more Fed interest rate increase in response to inflation, that is to be expected. We do believe that liquidity injections towards the longer end of the yield curve by the central bank could keep traded yields lower because that is part of finding solution. Inject a bit of liquidity and keep long-term yields lower. It may be seen as expectations of slower growth, maybe recession, but de facto we do believe this is something that we would see. Lower bond yields should over time result in risk assets recovering. That is something that we are very, very focused on, especially because lower bond yields will be accompanied with liquidity injections. In India also, we are beginning to see some dissent in RBI rate increase actions from the member of the committee, and this points to a possibility of our rate increase cycle ending soon. There is a debate if the increase in interest rates is now enough. Happily, the recent trade data points to lower trade and current account deficit, and Forex reserves have been sustaining. So this is important. Balanced external account and comfortable Forex situation would allow RBI more degrees of freedom, and maybe our monetary policy will get decoupled from that of the West. Global economic issues have impacted the commodity markets. Crude prices have cracked sharply from upwards of $85 to a barrel to a sub $75 to a barrel as we speak. India is one of the largest importers of crude globally and stands to benefit to the tune of 14 14 to 15 billion dollars in terms of savings on an annual basis if the prices sustain at these levels versus earlier levels. Lower commodity prices improve the attractiveness of India to global investors. So on a top-down basis, our country starts to look better. Indian investors are focusing on investing in debt/stroke insurance products to take advantage of the small window of opportunity left before the tax arbitrage that is available to insurance investors is taken away in the month of March. Now, the flow into debt should normalize and be more as per the right asset allocation as we move into April. As this month sees HNI interest come back into equity asset class supported by lower starting valuations. We have seen a market correction in the past period, better sentiment on account of lower commodity prices, particularly oil, and lesser attractiveness of alternate investments like debt on a post-tax basis. We believe that the starting valuations are very defendable. Our framework is that of 18.5 times 1 year forward earnings on the index as being a fair valuation range. This is higher than long period average because the complexion of the index itself has changed over time. And very long term averages are less relevant. If you go before 2007-8 kind of a period, the percentage of PSU banks in the index was higher, as was the percentage of commodity businesses. These spaces command relatively lower valuations. Now when we see the index, it is more on consumers, more on retail, more of insurance and private banks. With FY24 EPS expected to be in a 950 to 1000 range, the current level of index should be seen as a tad lower than fair value. So we do believe the levels are very, very defendable. This implies that one should expect earnings growth related returns as we go forward over a period of time. That said, on a pre-tax basis, debt does continue to look more competitive versus equities, but like we were making the point earlier, on a post-tax basis, equity will emerge more competitive. Financial 24 is expected to see a slowdown in nominal economic growth. So this is a challenge that market participants will face in the new fiscal. Slowdown will be a consequence of both a fall in real growth and a fall in inflation. Nominal GDP growth could be around 8 to 9% and lower than budgetary assumption of 10.5%. However, in spite of this, earnings growth could be between 15 to 20%. This is on account of margin expansion that is expected as a consequence of commodity price correction. Engineering, autos, consumers, cement, other manufacturing sectors should all benefit from margin expansion as we go forward. Banks are expected to see margins peak out over the next 2 quarters, but they again should see it sustain overall for financial 24 over financial 23. However, bank system-wide lending growth could see some slowdown in 24 over 23. However, lower credit costs and efficiency-related gains in cost structure should keep profit growth in line with business growth for banks. IT sector could see some benefit from lower attrition and higher utilization rates, while lower growth in new order booking should be expected. As a house, we continue to be focused on engineering and defense spaces, lending, new age tech companies, hospitals, amongst urbanization theme, retailers and autos in our portfolios. Lastly, we believe it continues to be time for alpha. Strength in earnings is getting wider spread. So while earnings growth may be lower, that growth will be available in a wider section of the market. Commodity price correction should support earnings of many companies across the board. In many industries like IT services, growth drivers may be more present for smaller companies, especially ones which are focused on verticals like travel, hotels, electric vehicles, connected cars, newer technology spaces, etc. Versus large companies for whom BFSI space usually dominates. We have seen senior level people movement in IT space from larger companies to relatively smaller companies, and this probably points to the same. Engineering again is a large space in the market, not in terms of market cap and composition of the index, but in terms of number of names which are present. Make in India focus, railway capex, defense indigenization are apart from PLI is helping many companies in this space. Growth momentum on China Plus One continues. All of these should imply favorable tailwinds for alpha seeking continuing in the next period. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.